Good afternoon, everybody. My name is David Jennings. I'm chairman of Movers and Shakers. A warm welcome to Movers and Shakers. I'm delighted that there's so many of you with us today. For those of you who don't know us, Movers and Shakers is the UK's leading property and construction networking forum, now in its 25th year, bringing together key players from public and private sectors across the UK. So we've been organising virtual events since April, a mix of interviews, presentations and webinars, and all of these can be viewed on the Movers and Shakers YouTube channel. Do go take a look. So welcome to the first in a series of 3 webinars exploring real estate investment and asset management organised in partnership with Yardi. Now today our theme is dynamic asset management in a post-COVID-19 world. We're going to be taking a strategic perspective and look at the real estate investment market. On the 9th of September, we have a second webinar, Adapting to Change, Delivering to a New Agenda, where we'll be taking an operational perspective. And finally, excuse me, on the 16th of September, Best in Class Asset Management, where we'll be looking to the future. Just a bit about Yardi. Yardi are a global prop tech provider with more than 7,000 staff in 80 countries. They have a staggering 12 billion square feet of commercial space managed on their Yardi platforms. They support the full spectrum of real estate sectors: commercial, retail, logistics, residential, and co-working. Yardi offers solutions for property managers, asset managers, investment managers, and property marketeers. And their newest suite of products is Yardi Elevate Suite, which helps asset managers with forecasting, deal pipelines, leasing, construction, and investments, a powerful management tool. So thank you very much to Yardi for their support. We appreciate it. So back to today. So until recent times, real estate has been a fairly predictable market, with conventional real estate leases underpinning most assets. And it wasn't too many years ago, and I'm old enough to remember, that 25-year leases were the norm. These typically had 5-year upward-only rent reviews, but oh, how things have changed. In recent years, real estate leases have become shorter, less conventional, and certainly less predictable, with shared workspaces in offices, turnover leases in retail, and short-term contract-driven agreements in logistics. And we're now at a stage where retailers are demanding change, failing in many cases to comply with the terms of their leases. Corporate occupiers anticipate more home working and less fixed space, greater flexibility, and improved terms. So in summary, the real estate market is entering a period of accelerated change. And as a result, it can be assumed, I think you'll agree, that asset management will become a more dynamic and complex process. So today, as I said earlier, we're going to take a strategic look at the dynamics of investment and asset management. And to make sense of what's happening, we have a first-rate panel. So welcome to Anne Breen, who's Global Head of Investment, Process and Asset Management at Aberdeen Standard, UK-based. Adam Pearce, who's founding managing partner at Kintyre Investments based in Germany. Richard Gerritsen, who's Regional Director, Europe at Yardi. I think he's based out of Holland. And our moderator, Louisa Clarence-Smith, Property and Professional Services Correspondent at the Times. Now, remember everybody, you can ask questions by using the tab at the bottom of the screen. Do get involved. But without further ado, I'm going to hand over to Louisa. Louisa.
Thank you very much. And yes, everyone, please do ask questions throughout the session. I'll do my best to ask them to the panel. I think I've established that we're all working from home. Is that right? Adam, are you working from home?
No, we've been back now for 8 weeks, but Germany is in a much different place than the UK at the moment. So I think that answers a lot of the. We'll come to that during the course of the next hour. But I think it's horses for courses.
Yeah, well, that's certainly the big kind of topic of the day in the UK at the moment, and I imagine as an asset manager and investment manager, that must be a huge topic that something you're thinking about in terms of how long that trend is going to continue and what that means. So fascinated to dig into that at some point. But more broadly, maybe to start with you, Richard. I mean, to what extent has the real estate investment landscape changed, do you think?
It's it was in the middle of a transition already, and I believe that it's in general terms, after every good crisis there is kind of a spurt, a growth spurt when it comes to adopting technology and also the development of technology. And I think that it hasn't necessarily changed, it has speeded up things. So to give you a very simple example, there was already a drive to use apps and to use other devices to provide services in a different way than just on a person-to-person level. And COVID has just pointed out how important it is and has speeded up the process for it to be implemented.
And Anne, how much time are you and your team spending sort of working out what COVID means for all the different real estate investment asset classes?
So my area of the business is investment strategy. So the key point of our entire role is to give direction to the teams and to, the near term, medium term, long term. And I think, in the post-COVID world, really the key points would be acceleration. It's acceleration of the trends that were already in place in retail and also in the office sector. And polarisation is the other word we use a lot. So actually, even within retail, there's very divergent fortunes, whether you're a supermarket or a shopping centre, and also in offices. If you are actually in central London, much more impacted. But as Adam had touched on earlier, if you are in Frankfurt or Amsterdam, it's a very different experience for office occupiers. So definitely polarisation. And then the final thing I would say is granularity, is understanding the balance sheet of the occupiers that we have in our buildings has never been more important than it is today.
Yeah, I know Aberdeen Standard, I think, is not, majority of staff aren't going back to the office until January at the earliest, it's said.
Mm-hmm. Yeah, that's right. But that's the UK. Again, go back to the point that Adam made. So we have got large teams in Edinburgh and London, and we're not forcing people to go back. So we're not expecting people to go back until after this year, and then we'll review that. But actually, our offices around Europe and Asia and the US are at different stages, and some of our teams have been back at work for a few weeks.
What do you think this means for the future of UK offices as an investment asset class? Would anyone, would you have to be mad to invest in a UK office at the moment, do you think?
I think going back to that point I made before about polarisation, so the trends in the office sector were already in place, moving towards more of a service base, flexibility, fuller services around about bike facilities, shower facilities, proximity to transport. I think what's happened is that in some markets that's become more exacerbated. In central London, dependency on mass transit, we'd be much more concerned about central London offices than we are other. But so I don't think you'd be mad to invest in offices, but it has to be, that point about it has to be granular. So, is it Bristol? Is it Amsterdam? Is it Frankfurt? Those markets are behaving differently and will continue to. And actually, is the building itself physically able to cope with the demands of future occupiers? Is it flexible? Is it modern? Is it smart? Is it, does it offer the sustainable nature that occupiers require? So one office won't necessarily behave like the office next door. So I think I would invest in offices, but I'd be very focused about where I was investing, and also making sure the building was as future-proofed as possible.
And do you think office leases will become shorter and more flexible?
I mean, this is a global trend. So the UK is quite unique in its lease structure. So most of the other markets we invest in around Europe and Asia have much shorter leases. And actually it's less necessarily about the lease structure and more about the sustainable nature of the income. Again, going back to that point about what's the building doing for the tenant and where is this located means that we can generate sustainable income. But yeah, I think offices, like every other sector, will see shorter leases in the UK, but again, in other markets, that's already quite standard.
And what's your view? I mean, would you advise any of your clients to invest in an office building at the moment?
Well, actually, yes, and I'm not meaning to be contrary, but I think that it's going to be a different type of investor. Yeah, I mean, the core pension fund buyer looking for a 10-year lease with a blue chip may not be able to achieve, the risk-rated returns that they're looking for. But if we look at a post-COVID sort of world, and I'm talking sort of not in the short term, because I think it's clear that flexible office space is going to come under pressure in the next 6, 12, 18 months. But in the medium to long term, my view, and it's not backed up by data yet because the data is not there, but it's my position on this is that the medium to long term is fairly robust. And I think one of the models that has been around for a couple of years, but it's sort of been under the surface a bit, and I wouldn't even say it's yet mainstream, but I think it will become mainstream. And this is this idea of a managed office where the owner maintains an element of the risk. So there are specialist companies out there, just like hotels. They can take a fixed term lease or they can take a management contract. There are a growing number of larger global players that are specializing in managing the flexible space on behalf of the owner. So it's a sharing of the risk. It's the WeWork model, but de-risked. WeWork took the long-term risk and tried to lease short-term, but that's moving to specialist players like Industrious, and I think there's a couple of London-based management companies that do this as well, where it's a sharing of the risk, but therefore you don't have the all-or-nothing position that you have with WeWork. And I think that is where it could go. I think we may even see a number of hospitality players move into that space, because ultimately it's going to be about entertainment, it's going to be about hospitality, it's going to be about making sure these offices are clean. And who are the specialists in that? You could see Office by Marriott, as these guys are going to struggle to get the business travelers, they're going to need to move somewhere. And I think that is something that people need to be paying a bit more attention to, and that's the managed office market. Now, that will affect who buys these assets because they won't be as secure as they were in the past. So I think it's more the private equity market, but I think that's something that everyone needs to be thinking about.
Do you think, Adam, that traditional office landlords possibly don't have the skill set that's going to be required to manage the office of the future?
Absolutely. So while I gave a long-winded answer for the first bit, I think that the second part is absolutely. If you're moving to a more flexible-based model, and I don't think there will be net a huge drop-off in office space. I think broadly, and I think a lot of people see this as well, and time will tell. The net space available won't change. It's just going to be how it's used, and I think that's the obvious consensus that it's going to be a different type of space. There's going to be a lot more, I think, what people are calling core plus flex for a lot of the large office tenants, where they're not sure if they need 100,000, but they know they need 70. So they'll take the 70,000 square meters on a fixed term lease, albeit shorter, and then use the other 30, 40,000 in swing space. That swing space cannot be held by a traditional office owner. That needs to be held by an owner that's willing, to share some of the risk. And that's not the pension funds that currently own these assets. It's going to be someone with a different risk profile.
And do you think the future valuation of offices will have to take into account the track record of an asset manager of a property, and how good they are at refilling space when it does become vacant?
I think it will, and I think in the short term there will be an adjustment, a negative adjustment for the assets that aren't attracting the fixed leases. But over time, I think the amount of money that will still be needing to be put into these assets will then force those yields to probably normalize again. I think it's just it's going to take a period of years before the investment market realizes that they have no choice but to buy these type of risk profile assets. And when it becomes more mainstream, and I think it will, I think the yields will come back to more of an investment grade position. So.
And Richard, you've been saying for a long time that the real estate industry needs to adopt more technology. Traditionally, it's been quite slow to sort of be disrupted by technology. I mean, to what extent do you think COVID is going to accelerate any further disruption?
Yeah, I think we, as a lot of other industries, there will be quite a high level of redefining ourselves. And what is an asset manager today might not be an asset manager tomorrow, and what is a property manager today will not be a property manager tomorrow. So and a big part of that will be about who is the client and who is the client really. Is that Yardi as a tenant, or is that Yardi as a global player that rents offices in all these different countries and cities, or is that in the end user that is working for Yardi, and to which extent is he or she facilitated in their needs for what they need to become productive and happy and successful and all of that. So I think there is, like in other industries, there will be a drive towards more facilitating at an end user level. Having said that, and that is, I think, in line with what Adam just mentioned, it's not only that, because it needs to be in a balance somehow. So you can't really focus on short-term, custom, or end user level services without having something on the other end that would be, maybe a higher price per square meter, because there's more flexibility, it's shorter term, and there are more services involved. So what I do expect, and I would say we're not at the start of this whole process, but the initial steps have been taken, is that there will be a shift towards how clients of the real estate industry will be serviced, and that is not with a 10-year lease of X many square meters, and no one cares what you do with it and how it is being used, etc. It will become something fundamentally different, and that will be in the office space, that will be in residential, and I'm sure that it will also happen in other property asset classes like retail, for example.
How better do you think landlords could use technology and data to sort of improve their asset management of buildings? What are they missing?
What are they missing? I think that there's a very high percentage of property data that is still being kept in data silos. So they are missing out in their ability to combine these data and to generate information from it. So that is one of the issues, I think, in real estate. So where you see in other sectors that data, as much as possible, is being aggregated and gathered in large operational platforms, in real estate it's still very much scattered. The problem with that is that if you really want to start understanding the client, whether it is an investor, but definitely when it is the end user and the tenant, you need to combine all these data, which is not only what is the length of the lease and what are the break options and all of that, but it is understanding the use of the space, when it's being used, how it's being used, etc. So it is really combining the smart building, the Internet of Things, all that data in combination with the more regular mainstream asset management data, and then you have you're ready for step 0 or maybe step 1 in using the technology when it comes to machine learning and artificial intelligence, etc., to really understand what the behavior is of end users in your office or in your office portfolio, or really understand what the behavior is of the visitors of your shopping center.
So traditionally, especially in the UK with retail, there's been quite a sort of culture of secrecy between landlords and tenants, I think, in terms of sharing data. That may change a bit as we move to turnover rents.
Exactly, because it's me as retailer A in a shopping center, I'm quite I can't be successful if the rest of the shopping center is not successful, etc. And I do understand there is this, that there is this little shift in thinking that needs to happen. But in the end, the sharing or using of the data properly will lead to a better result for individual retailers.
And
Do you mind if I jump in at that point, because I think Richard will like this, because it's heading in the right direction. And look, it might be different here in Germany, and I think maybe the audience is more UK centric, but we have a number of factory outlet centres, and while shopping centres in Germany have a mix of turnover and fixed elements, factory outlet centres predominantly are very turnover driven. To the extent that a tenant can leave if they don't hit a certain turnover, or we can remove them from the premises because they're not driving our value as well. There's a real shared risk. But the only way that model is working is with point of sales, direct centralized turnover information. So it's not that I don't trust our tenants. Of course we do, yeah, and I'll always say that. But all the data is live, yeah. The point of sales is all centralized. The information comes to us on a live basis, yeah. So that sharing of information can only be really as effective as possible if we are embracing this use of data pooling and the centralization of all this information. And so it is already happening in certain asset classes, and I think factory outlet centres are a model that people can look at, because for some reason the tenants feel comfortable in that context sharing their turnover data. In fact, they'll give it to you on an hourly basis, but that needs to filter through into other sectors. And I think technology will certainly help. And if Yardi can find ways to build programs and add-ons that can help us with that, then yeah, look forward to hearing about that.
And to what extent do you see turnover rents as a risk versus an opportunity?
So partly, just to go back to the point about factory outlets, I think it's a really interesting one, because I think that is a model that's demonstrated it works. The challenge that we have is not the same as a factory outlet, in the sense that it's about the online sales versus the returns versus the trading in store, and the information around that. And the challenge that we have is that often the retailer themselves don't have that information. So they can't actually provide and aggregate that information either easily or at all. So that provides us with a major challenge. And that then feeds into the challenge of turnover. So turnover, again, I said this at the beginning, but in the European markets, it's much more commonplace to have turnover leases in place, and they work and they function, and there's exchange of information between the retailer and the landlord, so they're more embedded. In the UK, is much less so, and I think it's partly about trust and exchange of information, and it's partly about availability of information, that the retailer might not have the information that we would look for. Because ultimately, a turnover lease should work well, should be mutually beneficial, because the retailer and the landlord are working together to generate the greatest amount of sales. And actually, if we look at it from the big bad landlord perspective, if that retailer isn't performing, then we should have the flexibility to move the retailer to another part of the centre or the park, and actually put a different retailer in there that works better. So the flexibility could work both ways, from generation of income, but also in terms of asset management.
Yeah, are you sort of saying that you also want to see some of the gain, as landlords should some of the gain from the online sales that are generated from that in-store visits?
Yeah, and you need to look at the sales in sort of an aggregate fashion, like by postcode, etc., to understand sometimes how that store might perform.
So Adam, sitting from the German perspective, do you think the UK is just a bit backwards in its take up of these kind of models, and it needs to just catch up?
Look, in many ways, we usually say it the other way around. When you look at the investment quality and the way, I've been out in Germany for 10 years, but 10 years before that, I was living in London and the UK, so I've had the experience of both. I would say in looking at investments in the way that the UK investment analysts look at it, I would actually say they're slightly in front. But then when you look at things like turnover leases in specific sectors, there is definitely a trail in adapting a best-in-class approach. So I'm not going to tar all of my friends and colleagues in the UK with the brush that they're 10 years behind, but certainly when it comes to the turnover-based model for retail, yes, certainly I would think that they can be a bit more forward-looking. But I think it goes back what I think we all were thinking or saying at the start, and that is that COVID is only going to accelerate trends that were already there. Yeah, and I think the UK was or is moving in that direction, and Germany and other European countries as well. It'll just need to make that happen quicker. And going back to the point earlier, to do that, we're going to need better data collection. Yeah, we're going to need the buy-in of the tenants to use our point of sale systems, to trust that we are going to be responsible with their data. But all this is already happening, but it's just going to happen a lot quicker now.
I mean, and just to broaden it out, I mean, to what extent do you think COVID is going to change the way we use buildings more generally, and the design of buildings across the different aspects?
Well,
will be a return in 3 months' time, or will we going back to our old ways?
Yeah, there's two points, and one is that the working from home phenomenon, that's a topic that we could have another hour session on, about how it worked, how it hasn't worked. But ultimately, there's a lot of discussion that it's very efficient. I would challenge that only to the extent to say it's efficient because what I would call so much social capital already exists. We already know our colleague. We've been working in the office with them for months, years. Every month that the lockdown continues, that social capital gets eaten away. And so while we might be efficient at working from home in the short term, as we lose that social capital, or as new people join the business that have never gained that social capital, I do believe that efficiency will become harder to maintain. Therefore, to answer your question, offices will need to continue to be used. I do think the Zooming and the team, Microsoft Team approach, that's not a fad. That is something very positive that's come out of COVID. That will continue. So I think that will mean a tougher time for business, hotels and things like that, and the airlines. But if you then move that into an office context, we have colleagues that sit at their desk and they do Zoom calls. I'm sitting in a conference room, and that's fine for 2 or 3 months, but no one's going to put up with that for 2 or 3 years. So if you just take that as a simple example, when people say that there's going to be less people in the office, there might be, but the same space was going to be needed. We're going to need Zoom rooms. Yeah, they might be just broom cupboards, but there's going to need to be 2 or 3 of those. There's going to need to be more meeting rooms. It's going to need to be more conducive to people meeting and talking and whatever the case may be. So the net office space, I think if you're an office owner and your office is flexible, I think you're okay. But you need to be prepared to look at the design, look at the layout, look at what people are going to need it for, and apply those changes. So working from home, I think it is something that is not going to continue to the extent that a lot of people are hoping. They will to a certain extent, but I think offices will change, and they were already changing. Forward-looking companies were looking at offices as a place where it's where the intuition and the teamwork is being driven from, not just a place to sit. The last point I'll say is that hot desking has had a really bad name in the past. Hot desking is not going anywhere. If anything, what is absolutely clear is that hot desking, or the concept that you don't have a hot desk, or that you don't have a fixed desk, is only going to increase. And it's a bit of a joke that we have around here. We call it dynamic working allocation. Just so we don't have to call it hot desking, because no one likes the term hot desking. So I think dynamic work allocation in the future is only going to increase.
And Anne, you mentioned that you were sort of anti-London offices at the moment in terms from an investment perspective. Would you invest in sort of regional offices? Do you see any kind of changes from?
Well, I wouldn't say absolutely against London office. I think I would, when the time is right, and we have only 20% of our portfolio in office and 80% in retail. So, but I would still rather be in larger office-based locations. There is a lot of discussion about having breakout hubs in the commuter belt. I think that could or might happen. But ultimately, I think there's going to be a lot of political pressure. Yeah, the government is going to incentivize people, and I don't know what that looks like yet, but they're going to incentivize people to get back to the cities. Yeah, and that might come through planning permissions, it might come through discount rail fares, or whatever the case may be. But I visited London for the first time in 4 months last week, and it's night and day compared to here and other Frankfurt and other European cities. There's going to be a push to drive people back to London, not the other way around. And until millennials are the decision makers about working from home and where the offices are, and they're not at the moment, we've got the older generation making those decisions. I think there's always going to be that pull back to offices in the more old school mainstream locations. So I think the mid to long term future is still quite strong for places like London.
What's the Aberdeen standard view of urban versus suburban? We've got a question from a member of the audience on this. I mean, do you think you'd invest in suburban offices going forward?
It's one of those really general questions, and I would answer it like a true researcher. It depends, but typically we're not a huge fan of suburban offices. Very typically, they depend on drive to work pattern, etc., which we've seen decline. Typically, those types of assets depreciate quite a lot, and so we're not massively a fan of suburban offices, but. It does depend what you define as suburban. So if we think about London being the UK capital, you could say that Reading was suburban to central London, and actually there are parts of Reading that we would invest in. So it's a very, very general. If we're thinking about an office park outside a city, then that would be something we typically don't invest in. But it's asset by asset. I'd be more concerned about the way the market itself functions, how dependent the market is on mass transit. And you touched on London there, where we were already becoming more negative on central London offices because they've had a really good run and they've performed so well. And actually other challenges are at play there. So COVID exacerbates that in terms of the dependency on mass transit, but also affordability, employee affordability of accommodation, commuting times, etc. These are all things that just become more heightened in this environment. So for example, if people are allowed to work at home 3 days a week, are they happy that their commute into London will be longer? Because actually they don't need to do it so often, or are some of the functions actually completely outsourced and they don't need to travel into London at all? So the affordability challenge places another pressure, I think, on the office market. And even from a client perspective, I think what might happen in central London offices is what we do in those offices will change. So our business is quite diverse in that we've got offices around Europe, but we often meet our clients in London because actually that's the easiest place for them to travel into. So what we do in our London office might be more about client meetings and client entertainment and collaboration, rather than on desk working.
London is also quite unique, and well, maybe Frankfurt as well, because my perception is that no one that works in Frankfurt and no one that lives in London, that works in London actually lives in London or Frankfurt, and they all commute in. And Adam made a comment about millennials, but if we look at Amsterdam, for example, so our millennial workforce who live this hip and happening urban lifestyle, they live in Amsterdam and they have this apartment in the right place. Having said that, it's only 45 or 50 square meters. That means that their drive to go back to working in the office is actually quite bigger, because when COVID really started off, they were confined to their 45 square meters, which was basically the kitchen table and the couch, whilst the people who, the older generation like me, who lived outside of Amsterdam and have their own office at home, for me that whole requirement to go back to the office is completely different. So it might change from city to city as well, which also ties into what is Yardi's need for occupying suburban office space versus something in Amsterdam that might be different. In the UK, we have offices in Milton Keynes and in central London, Waterloo. The situation there is completely different.
Yeah.
I was going to say another interesting question, just quickly jump in, from Isaac Thomas in Frankfurt, asking, what does this mean for sort of co-working space? I mean, will big businesses downsize themselves to shared office spaces? What do you think, Adam?
Yeah, I think the move, and I mentioned it before, I think the move is going to be to what they call a core plus flex. Yeah, so that they can't commit to the longer term. It is obviously cheaper if you've got the core lease in space locked away. But that's where I think if you look at the flexible working market, and let's just differentiate the two for a minute. Flexible doesn't always mean serviced. Yeah, it can, and it usually does, but flexible means shorter monthly, weekly leases that are on a rolling basis. And that goes back to the point that that's going to take a lot more asset management specialism from specialists who are going to deal with that. And I think Richard, as I mentioned, will like this. That's also going to need a larger embedding of technology. So to answer Thomas from Frankfurt's question, it sounds like I might even know Thomas, indeed, yes, I think they will downsize their fixed element, but I think on a net basis, the same amount of space is going to end up being absorbed by these tenants. Not in the short term. Let's be clear. We have a huge mountain to climb as we come out of COVID. We haven't really touched on that, but we're looking at a post-COVID discussion. But let's not underestimate the economic struggle that a lot of companies are going to have to get out of this. So when I look at post-COVID and I look at office take-up or retail, you almost have to concede that the next 18 months and maybe longer is just going to be a real tough time. And so therefore medium long-term decisions shouldn't be made during this period. Yeah, you need to have an element of clarity and data before you can make those long-term decisions. So I think that would be the position. Just one point, just going back to the Frankfurt versus London. I think what it comes down to, and Anne touched on it, was the affordability of accommodation, but also the commutability. And Richard was right. A lot of people don't live in Frankfurt, but they don't have such a commute to get in. We've been open now for 6 to 8 weeks. The opening up of our office was driven by staff demand. Yeah, the staff were actually asking to come back to the office. Yeah, and I've spoken to business owners in London. It's the complete opposite. Their staff have no appetite to come back to the office because they have an hour commute, and the cost of the transport is, not worth the effort. So I think, once again, you need to look at the various sub-markets to understand what's leading into that situation. So shorter commuting times, cheaper cost of living will ultimately change what those offices look like.
And Anne, I mean, at the moment, when you look at investment opportunity that had a large co-working operator in there, so if it had a WeWork or an office group, would you see that in the current environment as a positive or a negative?
A negative. We don't, to be fair, again, it's the same point I made earlier. Apologies for repeating myself, but we were concerned about that model for quite a while. So we have, I think, across 40 billion, we've maybe got one office that we own that's got an occupier like that in it. So, so we've always been quite live to that model and how sustainable it was. So, and so I think, going back to what Adam said earlier, I think that would be quite a challenging time for these operators.
An interesting question from Ray Goodyear, who's, I suppose, kind of fits in with the whole wellness agenda, but he's asking, do you see healthcare provisions such as private GPs and public health advisors being part of the on-site offering in offices or mixed-use accommodation going forward?
Sorry, Adam, I was just going to say my initial view on that might be that's one step too far, because I think most employers now offer the online GP service, etc., as part of their package and their staff package. What you do see in other markets, such as in Denmark, etc., sort of subsidised catering and those types of things. Usually the top floor is a really nice restaurant with organic food, etc., and maybe some facilities. So that may be the way we move, but I'm not sure about the healthcare provision as such. But Adam, I don't know if you've got a different view on that.
Yeah, well, the only reason we've just come out with a policy and so this is a very specific answer because it's dealing with my company, where we have just offered to staff and families that we will run, completely voluntary, obviously, a free vaccination program for the flu this year. And that's something that we will centralise in the office. Staff and family can come in, we'll pay for that. And we just think that, that doesn't need to be a short-term thing either. Now, clearly, this year is rather important that everyone's doing that. But I think going forward, it's these things that good employers. We can come on to what that means as well. It doesn't cost a lot, and it's not about the financial element of it, but things that are easy to organise, things that we can use to ensure the well-being of our staff within the office environment. They're here anyway. Why make them go to a doctor half an hour away when we can service their needs here? I think so. For us, we will look to increase the amount of support that we bring into the office. Now that may be a very specific COVID-related situation. What I can say though is we are quite long in urban regeneration, urban redevelopments. Almost all of our current schemes have an element of medical attached to it. So where you have the food offering and the fun offering and the apartments, we're also combining that with a large element of medical facilities on site. So not necessarily in the offices themselves, but all of our urban regeneration projects are bringing medical and other similar type services into those schemes.
I mean, can you see shopping centres in the future, having more healthcare uses?
Absolutely. I mean, shopping centres, and this is exactly right down the middle of COVID is just fast forwarding a trend that was already there. All of the shopping centres that we are redeveloping, we're reducing the tenants that have exposure to online and replacing them with service-based offering, not necessarily retail. So it might be the local solicitor, the general GP, the specialist GP, the specialist medical doctor. And so that's a trend that will continue strongly within shopping centres, that they need to be more service-driven. A lot of the large operators are focusing on leisure. I think that's an important component. At Kintyre, we're focusing on the service element of these places because people come there. They're there for a reason, but we think the reason that people used to go to shopping centres will change, and so we are retooling our shopping centres to be more service-based.
Yeah, and it's a trend that you see in the US as well, right? So it is where if you're more outside the New Yorks, etc., you see large shopping centers in the shopping center or in the direct vicinity, you have these locations where medical services can be provided, where solicitors are, etc. So this whole shopping center as a place where people come together and do many more things than just shopping is definitely something that you see in the US, and it's happening for years, I would say.
I know that Aberdeen Stanley has been trying to sort of reduce its exposure, especially in the UK, to shopping centres. I mean, what would a shopping centre proposition have to look like in the future for it to be investable?
Do you know, I think just actually listening to what Adam said and Richard, it's all about knowing your customer, and you need to understand your consumer base and their demographic and what they want from that centre. So it's never been more important. So connecting with that, so the shopping centre app, actually the town centre app that tells you what people are doing in that area and what they want from the centre, that's going to be even more important than it was historically. But definitely more multi-use. Actually seeing some traditional non-physical store retailers coming into shopping centres. We've already seen that, car sales, etc., coming in. So a much broader range. But ultimately, it comes down to your catchment, your consumer, and what they want.
On valuations, in the UK, traditionally, according to the RICS, the Red Book, they're typically based on sort of recent historic transactions. I know they're looking at broadening their guidance on valuations, but specifically in this post-COVID world, do you think we just need a complete rethink of how we approach valuations? And is that something that you're looking at?
Well, I mean, the valuation community will be able to speak better about this than I will, but I think there's a natural element of this that we need to be, it goes through retail, it goes through offices and some of the other operational asset classes we invest in, whether that be residential, student accommodation, etc., is to understand the way that the occupier is operating in that building will be more important in the future. And that's with retail as a perfect example. So when we start to have more, the uncertainty clause is left out of valuations, which is expected relatively soon, there will be scrutiny over how that retailer has been performing in the assets and the trade they've been achieving, etc. So I think that's just the way the whole market's moving.
Richard, do you think technology could be used in any way to make valuations more sort of accurate and trustworthy?
Two things about valuation. So first of all, to answer your question, I think yes, because technology provides more standardization. It makes the whole process more transparent. So in general terms, yes. I think that an interesting point in valuations and future valuations will be, what are the different elements of the valuation? So if you would look, for example, at an Amazon that, undoubtedly is an organization that is worth a lot, their main asset is the data that they have and their ability to process data into information and to tailor services around that. You could argue that a lot of the data that the Facebooks and the Amazons and the Apples and the Microsofts are gathering and the Googles are collecting and try to make use out of is generated in a piece of real estate, whether it is an office, whether it is a residential unit, whether it is a shopping center. So my position would be is that this is an untapped part of the whole valuation. It is, you could argue that it's not only the bricks and mortars and it's not only the DCF of the leases within an office building, but it is the quality of the data and the volume of the data that a property is generating that will be part of the valuation in the future, and then technology will play a very big role in that as well.
Yeah, I think we've got quite a few asset management professionals obviously watching, and they're probably thinking, well, how do we harness this data? How do we get hold of it? What are your tips for them?
How do you harness data? Well, first of all, I would say stop using Excel. That is because that's only for personal use, and that is not something that is not a means to make this data to use. It is. I foresee a world with large databases where all these different types of data, whether it is lease level data, whether it is operational facility management data on what is the temperature, what's the energy consumption of meeting room 1 versus meeting room 6 that is on the other side of the building. All that information, all that data is in principle there and available. It is just scattered around many different systems or many different databases or Excel sheets, and is only used in a very pinpointed. This particular specialist uses it for a specific task or a specific report, but the real value of the data is to put everything together in one big bucket and almost like unleash the computing power that that computers have nowadays, and let the computers calculate and analyze, because that's what computers do best and better than humans. Let them analyze what trends and what correlations are, and that is how you really can make data valuable for an organization. But it all starts with gathering data, as much data as possible, and then from there use analysis to come to a decision, a management decision on, an asset management decision, or a hold or sell decision, etc. But that is something that where the industry can or should it develop much towards to. I always, we were talking about GPs earlier. I always make that comparison with, which doctor do you trust more in his diagnosis? Someone who takes your blood pressure and looks in your throat and says, well, Mr. Gerritsen, I think you have this and this, or someone that, has this magic sensor that puts it on your arm and, that measures 200, 2,000, 20,000 different types of data, and from that comes with a diagnosis. I would say I would trust the second doctor a little bit more.
Adam, to what extent do you invest in data analytics, and to what extent does that play a part in your investment decisions?
Yeah, so I think probably should have acknowledged the conflict at the start, but we are a long-term user of Yardi, but that is just a pleasant coincidence. And through our working relationship with Yardi, we're working together to bring our elements of that system forward. We also have a number of other strategic partnerships with data analytics platforms. RealX Data, which is a German-based data analytics portfolio and platform that is the database that Richard was mentioning, and then is the output for that. As a company, we prefer strategic partnerships because we are a property company first and foremost, but we want to embed that data within our process. So that's how we do it. But to be a little bit contrarian, at the moment, our investment decisions are going to be driven more by gut feeling. Yeah, okay, I know that this is the forum to talk about forward-looking progress, and I do think all good professional asset managers are going to need to embrace technology and platforms that are analyzing that technology, and we are certainly one of them. But currently, as we talk about valuations, there is no valuation for a known asset at the moment. The data just isn't there. So if we're acquiring anything, quite often what we're seeing, and there's been a couple of transactions that closed last week that we are aware of, that we were involved with, the delta between the valuation and the final price that was paid bears no comparison. So I think, to answer your question on valuation, we're not paying too much attention to valuations at the moment. What we are doing is underwriting assets using our historic data, so looking at where we think rents can and will go to, and then working out what the price is that we can pay. Not saying, okay, that asset has historically traded at a yield of X, and therefore we'll pay X. We think for the moment that the disconnect between the reality of the investment market and the valuation that are carrying a book value, that there is just no ability to link the two. So yeah, I think, let me know if that's answered the question.
That did. Are you finding a lot of bargains at the moment?
And that's part of the problem. We have clients and partners, both private and listed. And clearly there's a bit more flexibility on the private capital side. But for our listed partners, where they have a valuation that's at 100 million and the market value for that asset is 80 million, and they get offered 85, that's a challenge to get it past their investment committee to sell it, because they're saying, well, you're 15 million off book value. So it's it's hard because the owners and the buyers, or the buyers and sellers, the disconnect is just too wide at the moment. And that needs to close over the next 6 months as the reality of the economic situation transpires. And this year will be a net seller, which is actually good. We've got some things away at the start of the year, but we don't expect to be getting any bargains between now and the end of the year, just because we have a very pessimistic view on the occupier market in the next 12 to 18 months, and therefore we reflect that in our pricing, and that then just creates a disconnect between the carry values of the existing assets.
Would you agree with that, Anne, or are you bargain hunting at the moment?
I would completely agree with that, actually. I think that we are expecting a period of 12 to 18 months of where we'll start to see a bit of distress in pockets, but it's not visible yet. And exactly the point Adam made, that we've got more distress coming through in the occupier market, which will translate into increased vacancy, etc. So I think we're in a kind of watch and wait. I mean, it depends. There's a whole load of funds that sit underneath that, and some will be buying, and some, many will be selling. But as a whole, I would say that we expect over the next 12 to 18 months to see some opportunities materialise.
And just final question for everyone before I think David jumps in with some closing remarks. I mean, do you think the COVID-19 is a threat or an opportunity for asset managers? Richard, you go first.
Like any crisis, short term it's a threat. I truly believe that long term it's a massive opportunity. It is not something that completely changes the world or completely changes, trending, etc. It is just speeding up a transition process that was already taking place, and is taking place not only in real estate, but in every sector, every industry known to mankind. So from that perspective, long term, I would say definitely an opportunity.
Adam, what's your view?
It depends if you're a good or a bad asset manager. There's going to be consolidation, but fully support Richard's position on it, that if you're a well-established, well-capitalized and professional asset manager, the opportunities that not necessarily COVID, but the acceleration of the trends, particularly in the retail market where we're heavily involved, just means that asset managers that know how to deal with problems and can demonstrate to their investors and clients, it becomes an opportunity. A little bit schadenfreude, but that's the reality of it. So I think we're very forward-looking and optimistic that our position as an asset manager, it's going to create a lot of opportunities for us for growth in the future. Unfortunately, that may be at the detriment of some other players.
What do you think, Anne?
I would put a slightly different spin on it, because as an investment manager, I would say that it demonstrates the active management element of real estate versus some of the other asset classes. So whether it's an opportunity or a threat, and Richard said near term it's a threat, but there will be opportunities. And actually, when you think about the growth in passive strategies across equities and bonds, etc., real estate is an active management, and it's never been more in focus, that we can position our funds into some of the long-term thematics that we see playing out, which will bring opportunity and obviously will bring threat. But as long as we try and structure our funds for clients in that regard, then we should deliver quite a healthy income return. Near term it's a threat, but over the longer term, where bonds are and funding costs are, it still delivers a really quite healthy income return. Thank you.
David, I don't know if you're there, but have I missed anything?
Can I just say, I thoroughly, from a selfish point of view, I thoroughly enjoyed that. Louisa, Adam, Anne and Richard, I thought that was absolutely excellent. And I love the idea of a real estate bargain hunt. I think Louisa, I think Louisa, I think we've come up with the next big TV show. Might be a bit niche. I'll just try and make one or two comments if I can quickly and bring things to a close. I love the bit about the trends in office, and I think the point Anne made is that some of the, if you like, the standards around what is a good investment in real estate and offices, location is going to become, I think what Anne was saying, is more critical. But a number of you said it's going to be more service driven. And also Anne made this point about some offices will become of less value, more redundant because of what they are and where they are. I suppose that's always been the way. There was this bit about a different investor coming into real estate investment, and this has always happened. I mean, when I was referring to the 25-year lease all those years ago, it was the institutional investment, and that's changed dramatically. Retail, a really interesting piece on turnover leases, and I love the contrast between the continent and the UK and the lack of transparency here. But as I think it was said, it makes a great deal of sense, doesn't it? If you could get the model to work, and if you could get trust on both sides, and this piece about live data collection, etc., it does seem to me to be an equitable answer. But obviously things need to change. But that brings me to the next point about data. And it just seems to me, and I love the bit that Richard made about Excel spreadsheets. It does seem extraordinary to me now that at any time we needed to collect data to, if you like, prove valuations, to show, if you like, that income history. Adam mentioned Industrious, and in my deep past, I remember Industrious was started, and basically what they did is they bought some, if you don't mind me saying, some very average industrial portfolios, transformed them, put on shorter leases, full non-repairing leases, and the income they generated was way out of sync, in my view, positively out of sync with the assets they had. But what they were able to prove when they sold it for a fortune was that they had this transactional history that underpinned the value of the assets. I won't go on, but I just say to you guys, that was absolutely fantastic. Thank you very much indeed. For those of you that are watching, this recording will be available shortly for you to view again, for you to send to your colleagues. Thank you to Yardi for supporting this and supporting the next two. Our next event is on the 9th of September, session 2 in this series, which is Adapting to Change, Delivering to the New Agenda, where we'll be taking the operational perspective. So thank you all for joining us. From our family to yours, have a great day. Thank you.